Guys, welcome back to a brand new video. I'm RexFinance, and today we're going to be talking about why I'm quitting dividend investing and going all in on growth stocks. Now, the portfolio that's on the screen right now is my dividends only account with M1 Finance, and this account has only been publicly revealed one time in the past, when I first started this YouTube channel. So yes, I was very cringy to watch back then. I mean, I get I'm still pretty cringy to watch, but back then it was really bad. So if you go watch that video, just give me a break because I was just starting out with this YouTube thing. Anyways, if you do go back and watch that video, you'll see I only had about $500 invested in this dividends only account. You can see that I've grown that to about $7,200 currently, of which over $700 comes from share price gains and another around $160 comes from my earned dividends. Today, I'm going to give different fundamental and technical reasons as well as my own personal thought process as to why I am shutting this portfolio down. Just as a preface for this video, I am not against dividend investing whatsoever. I think it's a very good tool for a lot of people, but for my own financial goals and the wealth I want to accumulate over time, it just makes sense for me not to have a dividend portfolio currently. Again, I'll get into that as we progress into this video. First, I want to say thank you to Aaron and Travis for recently subscribing, and I also want to say thank you to Svi, who recently joined my paid monthly membership, and I also want to say thank you to Ruben, who recently rejoined the membership. Lastly, I want to ask that you make sure you watch this entire video, and then when you're done watching this video, let me know down in the comment section below whether you agree with my stance on this or not, because I would love to hear that. First, to start things off, I need to note that the vast majority of the companies I own in this dividends only account are large cap stocks, meaning they're the biggest companies in the world. For example, I own Coca-Cola, I own Verizon, I own Duke Energy, I own Raytheon Technologies. The list goes on and on and on. And for most companies that pay a safe dividend with a reasonable yield on it, meaning 3% or higher as a dividend yield, they generally are large cap companies. Mid caps and small caps don't have the financial security in order to offer these dividends. Now, the reason I mention this is because we're going to be going through a Yardeni research report that was just put out recently. What I found in this report is relatively concerning to me for most large cap companies. What I want to focus on in this report is the historical forward PE ratios of large caps, mid caps, and small caps. I personally drew these black horizontal lines so that we could better see where forward PE ratios are trading at historically. For those that may be unfamiliar with the PE ratio, all it is taking the share price and dividing it by the earnings per share of the respective companies. It is one of the most popular and reliable valuation methods in the entire stock market. So as I zoom in on this, it's easy to see that the large caps have an average forward PE ratio that is higher than we've ever seen in the past 15 years. You'll see why I'm a little bit concerned about this. As we scroll down to the mid caps here, which is the middle chart on this document, we can see that the average forward PE ratio currently in mid cap stocks is more in line with what we've seen over the past 15 years, but it's also easy to see that we're still elevated a little bit from the average forward PE ratio. Now, as we scroll down further, we can look at the average small cap forward PE ratio, and we can see that this is way more in line with what we've seen historically over the past 15 years. Yes, small caps got way overvalued at one point in time, but in relation to the mid caps and large caps, the small caps are really the only ones that have come down to their historical valuations, the historical average forward PE ratios. And now if we zoom out on the average historical forward PE ratio so we can see more data, we see that the levels we're seeing with large caps right now, not only are they the highest they've been over the last 15 years, but they're the highest they've been since the tech bubble. Since I was born. In my lifetime, I have never seen large caps have a more rich valuation. I am 20 years old. That is pretty crazy to think about. Then if we scroll down to the mid caps, we can see that it's a little bit more reasonable, yet we're still elevated. And it's the same story. The last time we saw forward PE ratios of mid caps this high was back in 2015 and 2016, but then it goes back to the same tech bubble when I was born. However, if we look at the average small cap forward PE ratio since 1999, it's the same story as we saw on the last document, where the valuations on small caps are largely in line with what we've seen historically for years and years and years. You can see that the valuations on the small caps have touched my black line several times over the last 20 plus years. That is just not the case with the mid caps, as we saw. It touched a few times with the mid caps, but especially with the large caps, literally the last time we saw this was in the tech bubble. So when I saw all of this, this is what got me thinking with getting rid of my dividend portfolio. Not only are large caps overvalued, but typically large caps make up the bulk of a dividend account. So even if the dividends somewhat offset the valuations coming back down on these large caps, I'm really not going to gain any money. The opportunity right now is clearly in small caps and maybe even in some mid caps right now. But right now, I really don't want anything to do with large caps. So now let's go back to my dividends portfolio now that we've gone through all the valuation metrics. What I've been doing with this portfolio, and you can see it on the value over time chart right here, is I've been depositing about $500 a month into this portfolio. This is my smallest stock market portfolio by far outside of my Roth IRA, but the Roth IRA is small because of the contribution limits. That portfolio would be a lot bigger if I was able to contribute more on an annual basis. But anyways, I think it's everybody's goal with a dividends only account to build it to a certain size that eventually it creates a passive income stream for you. My personal goal with this portfolio was to build it big enough that by the time I retire, I would be able to live off my dividends only account without any other source of income. I don't know what's going to happen with Social Security. Nobody does. That might not be a thing that I receive by the time I retire. So this all sounded great. I thought I had a great plan to build this portfolio up over time, that at a certain point, this portfolio would grow big enough that I could live off the dividend income stream only without any other income stream. Not Social Security, not my retirement account, nothing, just the dividends only account. I wanted it to be a supplemental income stream for me as I age. But then I got to thinking some more. Is $500 a month really making a difference, or would that $500 a month be better served in a growth portfolio? I am 20 years old. In my personal opinion, I should be focused on wealth accumulation, not focused on passive income streams right now. After I build my wealth up, then I can deposit a large sum of money into a portfolio with a decent yield on it where I can start raking in that passive income. But building this portfolio up through the years just doesn't make sense. To me, I'm almost wasting that money because in the future, I hope that I'll be able to deposit a large sum of money and get the same exact yield as I would be getting if I just continued to deposit $500 a month throughout the rest of my life. On another note, I am a firm believer that compounding is the most useful and powerful tool in the entire stock market, where you can compound your returns and build your portfolio even higher and higher over time. But something to think about is that compounding effect really doesn't make a difference until you have a portfolio over $500,000, $500,000, and that is on the very low end. I mean, think about it. The average portfolio probably has a 4% return on it annually. With a $500,000 portfolio invested in dividend stocks and a 4% yield, that's still only giving me $20,000 a year in dividends. And then if I reinvest those, then the portfolio can start to scale up even more and more and more. But right now, where this portfolio sits at $7,200 and me depositing $500 a month in this portfolio, I mean, sure, the almost $200 I've received in dividends have been great. But I firmly believe that if I had invested this money elsewhere, I would have made far more than the combined $900 that I've made in this portfolio so far. So when I started thinking about all of these things combined, it just makes sense for me right now to get rid of this portfolio. Take my gains, take my $7,200 and disperse it into my other accounts so that I can invest in growth companies, particularly mid caps and small caps, where I can get a much bigger return than the 27% I've returned on this portfolio so far, especially considering that large cap companies, their valuations are ridiculous right now and they're likely going to come down. And what generally happens when large cap stocks go down is the indexes follow, but all of that money starts flowing into where the deals actually are. And we looked at it. The deals right now are primarily with small cap companies. There are also probably some mid cap companies that are tremendous deals right now. But looking at large caps, you can't make that argument. We haven't seen valuations like this since the tech bubble. That is crazy. Since I was born, we haven't seen valuations in large caps like this. So down in the comment section below, if you made it this far, what I want you to do is tell me if I am crazy, if I am missing something here. Tell me if I'm crazy. Tell me if you agree with me. Tell me if you disagree with me. No hard feelings whatsoever. I just wanted to be completely transparent with this and what my current thought process is with the stock market. The valuations don't make sense to be in large caps right now. The return I should be getting with this money is higher than 27% over the past 12 months. And more importantly, I'm 20 years old. I should be focused on wealth accumulation, not passive income. Later in life, after I've accumulated my wealth, then I can focus on passive income, deposit money into a dividends paying portfolio, and start raking in that passive income. But that's just not where I'm at in my stage of life right now. Anyways, I kind of rambled in this video. I hope it made sense. If you guys enjoyed this, hit the like button down below for me. Also, if you guys are new here or returning, hit that subscribe button. With that, guys, I'll be back with a brand new video later this week. Peace out.